So we're going to statement of financial position. After preparing your statement of profit or loss and other comprehensive income, the next thing to prepare is the statement of financial position. And when we talk about statement of financial position, we prepare it to know the position of a business. So that's where you get your intangible assets, your current assets, your non-current assets, your equity, your liability, which is non-current liability and current liability. So the value of the worth of the business is known through the statement of financial position. So we start. For the statement of financial position, our assets, your total assets must equals to capital, equity and liabilities. Capital is the same as equity. Get the point here. Your share capital and the owner's fund are your equity, plus liabilities must equal to your total assets.
Yes.
As soon as you prepare your statement of financial position, your total asset must equals to equity and liabilities. Yes. I think the point is clear there. Is it clear, please? Okay. So, we start with assets. For assets, we have non-current assets, intangible, and current assets. Why do we call them non-current assets? We call them non-current assets because these assets are expected to last longer than a year within the business. They are resources of the business, but they are expected to last for more than a year. Mm-hmm. Then we have intangible assets. For intangible assets, they are not physical. They are non-physical items, non-physical resources, non-physical, like your goodwill. It's about the value, the reputation of the business. Your goodwill, the intellectual property like patent, the trademark, the copyright. The value of these things can also, they add value to the company itself. Okay. So these are intangible assets. Do you get it?
Okay.
Then we have the non-current assets, which are plant, equipment, machinery. What else do we have there? Property. Aside land.
Yes.
Land is a fixed asset too, but it does not depreciate.
Yes.
So the value of land will continue to be the value of land. So you don't have a carrying value for land, but you have a carrying value for property, you have a carrying value for equipment, you have a carrying value for machinery and plants.
Okay.
So as soon as you are preparing your statement of financial position, the carrying value is what the carrying value is the amount that goes into your statement of financial position. And how do you get the carrying value? It is depreciation minus the cost of the historic cost.
Yes.
Depreciation minus historic cost. So here I wrote, the carrying value are recorded in the statement of financial position. In essence, the value after depreciation. So the value after depreciation is what you record in your statement of financial position. I think that is clear, right? Okay. Then investment, it's also an asset for the business. And when we talk about investment here, we're simply talking about the company's shares in other business, in other companies. Your company is ABC, and ABC company has shares in Apple.
Yes.
So the value of the shares in Apple is part of the assets of the business. You get it?
Yes.
It's an investment. You got that? Then we have our current assets. For current assets, we're talking about resources that belong to the business, but they are expected to be used up within a year, which means they are expected to be turned to cash within a year.
Yes.
So we have inventories. These are stock held by the business that they are about to sell. We have the trade receivables, your credit customers. They have to pay you within a year. Are you getting that, please? Yes. Cash and cash equivalents. We're talking about the cash the business has at hand in the premises, in the vault or in the safe of the business, and the cash the business has at the bank.
Okay.
They are all current assets. Then the current assets plus intangible assets plus plus non-current assets gives you your total assets. So your total assets must be equals to your equity and liabilities. So now we're going to equity and liabilities. Are you with me, please? Yes. So when we talk about equity and liabilities, this is the section detailed about the owner's fund and any liability owed by the company. So whatever liability means debt to the third party. So whatever you are owing as a business, this is where you talk about it.
Okay.
So we start with equity. Equity consists of capital and reserves.
Yes.
So for capital, we have the share capital, which is the amount of money invested by shareholders. Please, are you putting it in mind? Are you putting it in mind? Yeah, we have share capital, which is the amount of investment or money invested by the shareholders.
Okay.
These are the shareholders.
Yes,
we call it share capital.
Share capital, okay.
Through the issued shares. And you know what? For shares, we have preference shares, preference shares, and ordinary shares.
Okay.
Ordinary shares are for the shareholders, for the owners of the business.
Yes.
Preference shares are for people like you and I who are investing.
Okay.
Clear?
Yes.
Therefore, reserves, this is the profit generated but not distributed to the owners of the business, to shareholders. Reserves are profit generated that are not distributed to shareholders. Clear? So we have 4 types of reserves. We have the share premium. For share premium, it simply means that we are able to sell the shares above the nominal value. Oh, let's say the nominal value for this share is $5, and we're able to sell it for $7. $2 become part of our share premium.
Share premium.
Do you get it?
Yes.
So when you sell the shares above the nominal price, the amount left is called your premium. It's part of the reserve.
Okay.
Do you get that?
Yes.
Then we have the revaluation reserve. For revaluation, I told you about, when I was talking, I talked about the carrying value of property, the carrying value of plant, the carrying value of equipment.
Mm-hmm.
The carrying value, when you are able to revalue your assets above the carrying value, because the carrying value is what you record in your statement of value, financial position, after deducting depreciation from the historic cost. So if you are able to revalue, now the equipment value is 10,000, but maybe because of increase in assets worldwide or increase in income worldwide, the value of the asset increases. So you are able to revalue the asset more than 10,000. It becomes 11,000 or 12,000.
Oh, okay.
So that is the revaluation reserve.
Yes, yes. Okay.
Do you get it?
Yes.
The figure above the carrying value of an asset is placed as revaluation reserve.
Okay.
Clear?
Yes.
Then we have the general reserve. So these are amount of money that we are keeping for non-specific reason.
Okay.
Just a reserve. We're keeping it. So the transfer of profit to a reserve for a non-specific purpose. You make profit, but we don't know, in the future we might need that money. We put it in general reserve.
Okay.
Then the last one is retained earnings. For retained earnings, we're simply talking about the profit made that has not been returned or distributed
to the business,
to shareholders.
Okay.
Clear? Any question about reserves?
No.
Clear. So we go to non-current liabilities. For non-current liabilities, we're talking about debts that are expected to be paid after a year. Debts that are expected to be paid after a year. We call them non-current liabilities.
Okay.
Clear? Then for current liabilities, these are debts that has to be paid within a year. Examples of non-current liabilities, we have debentures, long-term loans, they have to be paid more than a year. Mortgages, more than a year. Then we have current liabilities, which are bank overdraft mostly.
Okay.
And you know what a bank overdraft is? Withdrawing more than your credit balance. So examples of current liabilities, we have trade payables. Your credit suppliers, you have to pay them within a year. Your credit suppliers is a liability. Then other payables, amounts owing like interest that you have to pay to your bank.
Okay.
Other payables. We have interest payable. Interest that are being paid. Interest of now, it is your expenses.
Yes.
Interest that you are to pay at a later date goes to your statement of financial position.
Okay.
Do you get it now?
Yes.
We call it other payables. Like the accrued.
Okay.
Then the short-term borrowing is like bank overdraft. I talked about that. Then we have the corporation tax payable. Corporation tax will be taken away from the profit before tax.
Yes.
But as soon as you prepare your statement of financial position or statement of profit or loss account and other comprehensive income, the tax you have to pay in the next accounting year after your profit is your corporation tax payable.
Corporation tax payable.
Clear? It is part of your liabilities, current liabilities.
Yes.
Then provision, you make certain amount of money, you provide them in case you have some liabilities in the future, like warranty. Yeah. Maybe you sell phones, and there is warranty on the phones you sold to your customers for repairs in case they get spoiled within a specific period of time.
Yeah.
So those expenses are on you.
On me.
So you make provision for that. It's a liability.
Okay.
Clear? Then we have our total liabilities, which is non-current liabilities and your current liabilities.
Okay.
Do you get total liabilities here? Non-current liabilities plus current liabilities.
Okay.
That is what? Your total liabilities. So your total assets must equals to your total equity and
Liability.
liabilities.
Okay.
Any question?
Okay.
So that ends all the items we have in the statement of financial position.